Well, good afternoon, everyone, and welcome to the Arrow Capital Liquid Alts webcast. My name is John Tedesco, and I'll be your host for today's call. I'm joined in the room with me today by Jim McGovern and Chung Kim, and also Colin Whitehead, our technical producer for today's presentation. And on behalf of everyone at Arrow, we thank you very much for joining us today. We always appreciate the opportunity that we get with you. During our time together today, our presenters will provide you with an update on some of the liquid alt strategies that we offer, as well as share their thoughts on the latest developments within the global macro landscape. You will have the opportunity to ask questions via the Q&A box at the bottom of your screen, so I would encourage you to please feel free to submit those, any questions that you might have for our speakers today. We'll go to the disclaimer side. And the next slide, please, Colin. Here's a quick review of our company, and I would like to particularly highlight the global expertise in liquid alts and active portfolio management. This is something that we're very proud of and have focused on for over 20 years now. It's something we've built a reputation of being successful in executing, and something that sets us apart from many of the other alternative investment providers, and certainly many of the long-only mutual fund complexes. A little bit about our presenters today. Jim McGovern is founder of Arrow Capital. And what you'll come to know about Jim, if you don't already, is that he's very much a proponent of active management. And it's been under his leadership that we've gone down this path of alternative and active management and built out a complex that delivers with award-winning mandates and a successful investment approach year after year. Chung Kim joined Arrow in April 2020, bringing 15 years of experience on the institutional equity side, having worked with most of the alt managers in Canada. And what you'll come to know about Chung is that from this experience has been able to hone his skills to become a very proficient stock picker and alpha generator. This next slide highlights the funds that we're going to talk about today, but I should mention these are funds that are managed internally at Arrow. We do offer a fourth alt strategy, the Arrow EC Income Advantage, which is managed by our longtime partner, East Coast Asset Management, and focuses on Canadian investment grade credit spreads. We did have a call yesterday with East Coast, and some of you may have joined us for that, but if you weren't able to dial in, we would encourage you to reach out to your Arrow representative for the replay. As we all know, fixed income had was a challenging space to be in last year, but the Arrow EC Income Advantage finished with a positive return of well over 2% net of fees. This in a year when many bond funds finished with negative single, if not negative double-digit returns. This year, Income Advantage is already tracking well above last year's return, and it's only mid-February, so we would encourage you to consider the strategy if you're looking for a manager in that space. Today, however, we will focus on the macro and the equity mandates of our liquid alt lineup, and this slide does highlight our performance. We are tasked day in and day out with providing strong risk-adjusted returns for our unit holders, and I'm pleased to share that Canadian Advantage has been awarded the Fund Grade A+ Award for superior risk-adjusted returns for the second year in a row. This strategy is a collaborative effort between Jim and Chung, and I think it's this achievement that underscores the team's strength of stewardship and their ability to deliver over some of the most volatile periods in history. Global Opportunities is coming up to a 3-year number. Chung's fund finished over 4% in 2022. And if you think back to what I said about Chung during the intro, this can be well attributed to his ability to manage risk and generate alpha in what proved to be a very difficult market environment to do so. And our Global Advantage, with its history of very low drawdowns, continues to exhibit the qualities of an institutional or endowment style approach to capital preservation. And so with that, I'm going to turn it over to Jim to take us through the next few slides that will focus on Global Advantage. And then following Jim, Chung will walk us through the Canadian Advantage and Global Opportunities.
Great. Thanks very much, John, and welcome everybody, and welcome to those who will be listening to the replays down the road. As you know, I won't bore you with the details of how we look at the markets because many of you are familiar with our approach. But suffice it to say, we focus on two key variables. One is the rate of change of real GDP, and the other is the rate of change of headline CPI. So just to bring you up to date, as you know, we've been negative on economic growth, real economic growth for some time, and we continued that into the new year. You can see our estimates, which are in the blue versus the consensus estimates in the yellow. It's getting a little squishy here as we get close to the zero level. but we're forecasting a continued push down in Q1 and Q2 of this year. The good news is we are forecasting a better outcome in the back half of this year for GDP. Modest, but better, which is good. Here we have the other variable, headline CPI, and a couple of points here. And this is really where the issues are, we think, in the market right now. Like everyone else, we have headline CPI falling year over year this year, but much less so than consensus. So we have it falling fairly reasonably in the first quarter. We'll start to see some data shortly on that. But really, it's the out quarters in Q2 to Q4 where we're more forecasting a sticky level around the 4% level. And that, we think, is going to have an impact on the Fed's reaction function if we're proven right. It might actually have a sort of a negative feedback loop into our more positive outlook for GDP, but we'll have to save that for further data collection. Interestingly, for those of you who don't know, we apply this model to international markets. We've been doing that in this fund for a while and also in our new Global Growth and Income Fund. And this chart, there's a lot of color here, but it just shows you we've got markets in Quad 4, Quad 1, and Quad 3 around the world at different times. And this will allow us to allocate capital and diversify the fund a little bit better, because it's the first time we're getting sort of a desynchronous type of global economy. And that's largely predicated on China and Japan, which are now interesting long markets. But both have their challenges from exogenous policy issues, but we'll maybe talk about that a little later. The good news here is that we are actually finding markets if you're an equity investor to buy. So speaking of global markets, with respect to global policy rates, are we there yet? You could have argued coming into this year, after looking at the rather nasty December data that we got in the United States, and Powell only raising rates by 25 bips in January, that maybe the worst was behind us in terms of the rate hike cycle. And then we got the January data, or have been getting the January data for the last little while, and it's as much as December was very negative, January is extremely positive. The truth is probably somewhere in the middle, but the market has, you can see, moved up its forecast for the implied terminal rates pretty much around the world, but especially in the United States. It's going to be really critical this year to get the path of rates correct, i.e. how this plays out over the year. And of course, that will also mean getting the path of inflation right over that period as well. But suffices to say that these rates going up are generally not positive for either for risk assets in general, whether it be bonds or stocks. So where we are right now, for many of you that love to follow macro traders like Stan Druckenmiller and others, they would tell you that in order to get inflation under control, you really have to get the Fed funds rate above CPI. And here in this chart, you can see we've been gradually moving up the curve steadily, and inflation has been falling down steadily, but we're not above yet. So it's going to be a combination of those things moving in the similar directions for us to get there. A lot of people have been calling for a more hawkish position in the government, by the Fed to sort of nip this in the bud a lot quicker before inflation expectations set in. But this is the path that they've chosen. For those of you that are fans of the Taylor rule, you'll know that currently suggests that rates ought to be 9%. So there's clearly more work to do. On the inflation front, though, you can divide inflation really into two key components. One is the services side, and the other is the goods side. Now, the goods, as we all know, goods inflation has been falling dramatically as supply chains have gotten better, and it's fallen from sort of level of 12% a year ago down to 1.3%. It probably has a little bit further to fall, but the bulk of this move is done. In fact, if you look at inventories, we may in fact see this start to tick back up again. Where the Fed is really focused, as you all know, is on the services side, and particularly Powell is looking at core PCE ex shelter. Shelter has been a big issue for the market for a while. Everybody knows that it's a lagging indicator of inflation, the way it's calculated. So even taking that out, though, you can see that core services, less rent of shelter, is still up in the 6% range. Now, that is expected to come down a little bit, but when put in context of a 2% target rate for the Fed, we're really not in the ballpark just yet. When you're talking about the service side of the economy, you're also talking about its key input, which is wages. And here we show wages, while they have come down, in particular, if you follow the CPI BLS number, which is around 4 now, you can see that there has been progress made. The reality, though, is that for many consumers, real wages are still negative, but in some respects, if you look at the Atlanta wage data, in certain key industries, and particularly in the job switcher category, which we think is an interesting one to track, because a lot of businesses are, rather than hiring and training new people, they just want to hire somebody that can plug and play right into the business, and they're willing to pay more for that. And given the labor supply issue, it's not surprising that number also remains quite elevated. You know, the Fed is, without overtly saying it, the Fed is basically hoping for a recession, or needs a recession really, to get inflation under control. And so people are now really focused on these claims data that comes out on a regular basis. If you see the continuing claims, you can see that they've sort of not hooked up, but sort of quietly is sort of starting to go back up. But initial claims, and where they should be at the start of a recession, and where the Fed is kind of looking for in terms of the employment levels to fall, we're really nowhere there. So this labor market is not really listening to the Fed, and it continues to march to its own drummer. In terms of what that means, this is basically a nominal income proxy. It just takes hours worked and the wage rate and the amount of people and so on and so forth, and you get a number around 8% right now, somewhere between 7.75 and 8, depending on how you calculate it. That's a pretty decent year-over-year growth, and again, not showing any real. It's showing a slowdown, but again, really elevated versus history. And that's really a function. We think the key culprit is the labor supply issue, and that is one where, while estimates vary, we think there's roughly 4 million people sort of out of this potential labor force due to supply issues. The Fed had a good paper on this. They're really focused on the idea of early retirements and the demographic situation, but it's also quite evident that long COVID, opioid crises, and things like that have really impacted that labor supply pool as well, and that in turn is obviously putting pressure on businesses and the price of labor. Interestingly, another one of the Fed's mantras is that they can, through monetary policy, they can impact the economy by changing the financial conditions. And here we see these financial conditions have actually gotten a lot easier over the last little while, and this is really driving the Fed nuts, I'm sure. But if you overlaid a chart of credit spreads and other different things, you can see that we're just not at a point right now where you could consider the financial conditions really tight. And that's somewhat shown here on a profits proxy. Here we just look at the employment cost index against nominal GDP. There's that little spread there. You can see that employment costs up, nominal GDP starting to roll down, but we're still got this positive number, and this almost maps perfectly with profits right now, which we see have peaked and are starting to come down. And this is Bloomberg estimates from the broker dealers out there. You can see that we peaked at roughly the same time as nominal GDP peaked, and that's not a surprise because that's the key driver for profits, and we're now finally starting to roll over. Interestingly, money supply, a lot of folks are looking at this now. If you look at M2, you see this massive hookup right at the time of COVID. We went from 15, 16 trillion dollars of money up to 22 roughly at the peak, a huge increase. And yes, you can see M2 and ODL is just a more refined measure that we like to follow, but most people look at M2. But M2 here is actually now negative. We think it's going to continue to track negative. The problem is there's just so much excess money in the system that it continues to help levitate. So we're going to need to see some more contraction here. I'll give you an example. There's about $1.2 trillion of bank lending last year. And again, that just takes a sweet time to get through into the system. And then the last sort of chart, global money supply. So we just add up all the M2s of the major markets. Here you can see, interestingly, a move up. And so a lot of people have said, oh, the market's going to move higher because money supply globally is getting better. That is really a function of Japan and China. For those of you who follow Japan, you know that they're trying to defend their 10-year rate at 0.5%. And to do that, they're printing the hell out of yen right now. And China as well is on a campaign to ease. So those two things have helped ameliorate the fall due to the US and soon to be ECB QT programs and so on. So that's had a little bit of a respite. We think that's about set to roll down again. In particular, roll down hard if we get a more hawkish BOJ. So just to sum up our economic views, US real GDP and CPI still expected to head Q2, but in a sticky way, sticky down, and that creates a relatively unattractive risk-taking environment in US assets. China, we think it's an attractive entry point for Chinese equities and Japanese equities, but there's issues. China has obviously issues with respect to real estate and other simple things like rule of law and so on. But both, statistically speaking, are looking quite attractive and relatively cheap as well to the US. Why is the market running so hard now? Well, some of the economic reasons we mentioned, but it could just be that the markets are front running. They're front running change in our inflection in real GDP later this year. Maybe they're front running a quicker fall in CPI than we're expecting. Maybe they're front running potential Fed rate cuts in the back half of this year, although those have been kind of squashed. We're not sure, but given our sticky inflation view, bonds and equities, we think both look pretty expensive here. Before I turn it over to Chung, in the portfolio itself, we divide our fund into two pieces. One is a macro trading piece, which looks at the highly liquid FX, fixed income, credit, and so on markets. And then another is a global long short type portfolio. On the macro side of the product, in fixed income, we're long quite a bit of 5-year tips, and then we have this hedge with some long TLT calls if we're wrong on our inflation call. In equities, again, net short, continue to be net short. We've been net short for so long. It's getting tough, but we do see light at the end of the tunnel. We're long some China and Japan, short US in general, long defenses and short cyclicals outside of energy. And Chung will have quite a bit more to say about energy in a minute. The long defensive short cycles has been a nasty, tough trade so far this year, but so we're trading around it and trying to hang in the pocket as best we can on that. FX is where our big bet is. We're just long US dollars against pretty much everything right now, but in particular against pound and against sterling. And the reason for that is we just think the central banks in both those markets are going to have a tough time raising rates given the dynamics of the housing market and the degree of variable rate mortgages that are in existence and rolling over now. So the probabilities of them being as hawkish or as aggressive as the Fed, we think, are low, and that's why the US dollar position. And then commodities, we're long gold, oil, uranium, agriculture. We're big fans of the long-term real asset trade here. And we are short some industrial metals on a cyclical basis. And then finally, in our long-short portfolio, no big surprise there, but in general, prefer quality over junk, really selective. We're finding interesting opportunities in value and growth, and definitely a large cap bias. So with that, I'll turn it over to Chung. And there's our basic allocation.
Thanks, Jim. So, yeah, so as Jim mentioned, I work with him on Canadian Advantage, where it's a bit of a blend of the top-down macro and my more kind of bottom-up fundamental views. That's been since mid-2020. And I also am the lead manager on Global Opportunities, which also started kind of June, July of 2020, where 100% of my fundamental views are expressed in that fund. So for those that may have been on this call a couple months ago, or if I've kind of chatted with over the last little while, a lot of my views fundamentally would not have changed much over the last couple of months. So I'll kind of just take us through kind of the baseline views in terms of our views, kind of more kind of longer term, and then we'll kind of maybe dig into what we think is happening kind of shorter term. So we had pivoted kind of mid last year under the premise that a recession was going to be the base case, and that was for a lot of different factors. And kind of with that new premise, we had shifted our allocations and exposures to be much more defensive for the second half of 2022. And part of our premise is a little bit more of kind of a longer term kind of top-down view. We think that a lot of the tailwinds that the market that had been driving the markets over the last 40 years, and maybe more specifically over the last kind of 12, 13 post GFC, a lot of those factors may be in the midst of reversing. And with that, there would be some pain in between through a recession and potentially a regime shift on the other side from an investment perspective. And so that's kind of informed how we've thought about portfolio construction over the last 12 months. In terms of that regime shift, like I said, there probably is more pain to come in terms of a recession. As Jim talked about, earnings are starting to kind of deteriorate, although our view is they can still go down further. We think that hasn't been priced in. And within all of that, we think it's just too early to take risk at this point, and we're still pretty defensive. So when I kind of talk about that regime shift, other like really smart managers that I like, I've kind of talked about something similar, whether it's Howard Marks. He wrote a letter in December talking about regime shift. As kind of Jim mentioned, Stan Druckenmiller is someone that we like to kind of keep in touch with in terms of kind of what his views are. But so everyone might have a bit of a nuance in terms of what their views are. My view is pretty simple. I think there's been a lot of things, a lot of themes, a lot of factors that have driven the markets over the last kind of 10 years and maybe even 40. And coincidentally, a lot of those factors may be in the midst of reversing. And the simplicity of it really is inflation. And that's kind of what is tying everything together. But coincidentally, there's a lot of other factors that are kind of coincident or correlated to inflation / deflation, whether it's just kind of excess liquidity, the Fed put, ESG investing, globalization. A lot of these factors, I think, were pretty powerful. And again, my view is that we're in the midst of reversing those. I think with reversing some really major themes like that, it doesn't happen overnight. It doesn't happen in a year. I think it's a process. And my view is we're kind of just at the start of that process. So our premise in terms of a recession, there's a lot of reasons as to why we think this way. But if you kind of just boil it down to kind of a simple chart that I kind of like to look at, this is just kind of historical CPI overlaid to historical recessions. The gray bars are recessions. And since World War II, there hasn't been an occasion when CPI has been over 5% and we have not gone into a recession. Obviously, everyone's a little bit different. There's different kind of contexts and factors, but I think there's guidance to following or paying attention to history. Obviously, it's possible we could be in the midst of a soft landing, that we avoid a recession, but based on the probabilities, we think that that's a low probability. So this is just snapshot into this year. Everyone obviously kind of has seen what's happened so far this year. Things have flipped very quickly in terms of sentiment, price action, etc. So obviously a big move in terms of all the losers last year's losers, exacerbated by probably a historic tax loss selling season. So I think a lot of other factors are in play as to why there's so much volatility in the market in terms of reversions like these. But having said that, I mean, this is testing a lot of people's, including our kind of bearish positioning and thesis. And kind of just taking a step back, though, this is not that atypical for bear markets. We actually saw probably 3 or 4 real big reversion bear market rallies last year. Each of them faded, obviously. Kind of my view is we're in the midst of another one. I think contextually, there's other things in play, whether it's kind of seasonality, obviously on the back of tax loss selling, turning the calendar. But ultimately, we think that a lot of this was kind of short covering and some of those dynamics in play, and that we think the move will fade. So just on that short covering, this is just kind of one broker's analysis. This is Goldman Sachs. It's a snapshot of what they thought happened in January. So if you just kind of look at the red line there up top, that's basically as kind of it spikes to kind of that line, that basically just indicates the level of short covering relative to history. So January, by their estimation, was the 4th largest short covering month of the last 11 years. 3 other instances were actually October of 22. If you remember the CPI print that came out on in October, and there was like a massive reversion rally. January of 21, which was kind of the height of the GameStop meme frenzy, and there was another occasion in 14. All that to say, on the back of those, there could obviously be some legs there, but ultimately, in my view, they will fade, and not necessarily representative of kind of a fundamental underpinning that would support a new bull market, but more, again, just a reflection of volatility within a bear market rally. So I like to look at kind of prior cycles to kind of give a bit of a signal or a bit of guidance to kind of what's happening today. I'd like to kind of pay attention to kind of how things worked in 2000, 2001, as well as the 70s. I thought there were some similarities, not identical, obviously, but as they say, it's not identical, but it rhymes. And so it's kind of interesting when you kind of look back to 2001. Obviously, if you remember, the NASDAQ bubble, the tech bubble popped in March of 2000, and 2000 was a pretty bad year. Interestingly, the first month of 2001, the laggards of 2000, which were down 31%, actually rallied 17% the first month of January. Subsequently, that rally failed in February. It was down 15%. And if you kind of followed it for the rest of the year, it troughed late September, down 43% from the peak. And ultimately, the NASDAQ was down over 20%. And that's just kind of more of a reflection of kind of what can happen in a bear market rally. And it's kind of interesting in terms of the similarities. It's not identical in terms of the setup to today, obviously, but there are some similarities. That jobs print a couple of weeks ago, obviously, a lot of people kind of cling to that as a little bit of a support that there's a soft landing and everything's okay. But prior to recessions or prior to kind of big potential drawdowns it is not atypical that unemployment is at cyclical lows, and that's kind of what it was in kind of January of 2001 as well. Similarly, earnings were declining, kind of like what's happening today. Two key differences though, is that inflation was not really an issue back then, and the Fed was actually already cutting back then. Whereas obviously we're kind of nearing the end of the tightening cycle. Well, some people believe, I'm not sure if I'm in that camp, that they're near the end of this kind of tightening cycle. All that to say is this has happened before, and it's not necessarily a reflection of a new bull market in our view. So on the earnings front, this has been, a lot of people talk about it. We're in this camp as well, that earnings continue to be toppy. So if you look at the chart on the right, this is from Wolf Research, one of our kind of research providers, and it peaked around 250 mid 2022. It's been steadily declining. We're at 224 as of this week. It's interesting if you kind of look at least kind of Wolf's assessment of consensus. You look at Q3 and Q4, the assumption is that there's growth on a year-over-year basis in Q3 of 3% and growth of 10% in Q4. I just think that's too aggressive, especially given our premise that a recession is a high risk, especially the second half of this year. So ultimately, we think those numbers specifically in H2 are too high, and there's still downside here. A very quick assessment in terms of Q4 earnings. So we're almost through S&P earnings. And if you kind of the above chart is basically just the historical representation of kind of earnings surprises over the last kind of 10, 15 years. And so far for this quarter, the earnings beats are relatively muted. What is that, 0.9% as a composite? And if you kind of look at that relative to history, that's actually the lowest beat percentage since the GFC. And if you kind of look at the bottom chart, again, guidance is muted. Relative to kind of recent quarters, you are starting to see a decent deterioration in terms of kind of outlooks from the companies. So if you kind of looked at that as a picture, you would assume that the markets were going to be challenged, but clearly the start of this year, that's not true. This is kind of a real-time PE ratio for the market. We've kind of, with this recent move, we're back up to 18, which obviously in that context is kind of on the kind of mid to kind of upper end of history. Again, we think if earnings continue to decline, we think the multiple ultimately declines as well. So this is not sustainable in terms of multiple. The market is expensive. And, if you were to look at this as a stock, if you were to believe that there's risk to the earnings and the multiple, it would be an easy decision, sort of what you would want to do, which is to be cautious or be out of the market. So where can earnings go? This is not a prediction by any stretch, but if you kind of looked at history of recessions, earnings generally go down 20% peak to trough. Again, they kind of peaked around 250. If you kind of cut it by 20%, you get something around 200 or 190. This actually kind of correlates with the Wolf Research guys. I think they have like a 190 number for 23. And again, usually the multiple compresses. On average, it goes to 15 times. In that premise, you get the S&P at 2850 or a 30% drawdown from here. Again, this is not a prediction, but this is just kind of us being open-minded to the various scenarios that could be probabilistically in play. And obviously, given what the market is doing today, we still think there's more downside. We get asked the question a lot in terms of when we would get constructive. Reasonably simple from my standpoint. It's when kind of I believe earnings have bottomed and or a lot of the downside or negativity is priced into the markets or stocks. And you can kind of marry that with leading indicators potentially exhibiting a bottom, whether it's PMI, ISM claims or claims topping. And we think it's premature. It's still a couple of quarters away. So I kind of mentioned earlier that kind of my view is when there's a new bull market, that there could be a regime shift. So again, this is not kind of where we are today in my view, but I do think that when there is a new bull market in play, that there generally is a change of leadership. So on the other side, my view is that the new leaders are going to be commodities. And that's kind of across the board, but there's certain ones that I like kind of better than others. But again, this is kind of more of a longer term view as we think things have bottomed. So given all that, this is how we're positioned, or how we're thinking in terms of portfolio construction. Capital preservation has been a priority for the last year. It continues to be a priority. So with that, cash levels are high, our net and gross exposures are quite low. Given what I kind of said in terms of what type of sectors I like, kind of short-term, long-term, our largest sector weighting is energy. Our lowest or kind of sectors that we're short are tech and consumer. And we'll obviously be tactical and try to be opportunistic given the volatility in the markets. But generally speaking, this is how we've been positioned for the last couple of quarters. And for now, we don't see it changing much. So again, it's just a snapshot of Canadian Advantage relative to the market and other funds. And this is a snapshot of global opportunities relative to the market as well. And this is Jim's Global Advantage. Same thing. Sorry if I stole your thunder.
That's okay. No, that's fine, Chung. And, I think what we'll do is we'll pause there for a moment and we'll open it up to questions. And Jim, perhaps I'll start with you because there's a question in the queue, and it's what's the situation with the shiny new object, quote unquote, of ODTE options trading so much lately? What's the purpose?
Okay, purpose is pure speculation. And there's a lot of discussion, as this is kind of the newest twist on market structure. And it has actually impacted measures like the VIX. Like a lot of people look at the VIX as a gauge of fear and so on and so forth. That VIX typically has sort of 27 days to maturity kind of thing when you're looking at it. And these are 1 or no days to maturity. So they're pure gambling vehicles. I mean, I think they heighten the potential for a flash crash kind of scenario. I have no idea what purpose they serve at all. I wouldn't be surprised at some point if there's a regulatory move against that kind of stuff, but we'll see.
Great, thank you. I'm going to ask a question amongst the two of you. How often are you meeting regularly with regards to revising possible changes in the portfolio, whether that be on Canadian Advantage, and kind of what's a change in the macro environment, whatever it might be? How often are you having that communication?
Well, we meet every morning. We have a morning call with the whole group, analysts and PMs and so on. And then we have breakaway meetings through the day and through the week. Chung and I talk frequently, but I don't really want to influence him too much. I'm sure he doesn't want to influence me too much. But if you sort of were paying attention to the presentation, we're basically exactly the same. We've come to it from different angles, so to speak, but we're basically on the same page. And if we weren't on the same page, we would certainly have a lot more discussions about it. But I think we've been on the same page for quite a while. And in fact, a lot of the dialogue is either confirmatory or non-confirmatory when you hear what companies have to say about what's happening with their business and what bigger macro type variables might be indicating is happening to a business, like credit spreads and things like that. I think it's actually a really nice combination of bottom up and top down.
Great. And Chung, I'm going to ask you a question that I get often. How do you approach global opportunities differently than you would when you're working with Jim on Canadian Advantage?
Yeah, I mean, lucky for me, to be honest, I don't approach at this point. They're quite similar. The amount of overlap on the portfolio for global opportunities to my contribution to Canadian Advantage is extremely high. And so kind of Jim just kind of touched on it. I think we have a Canadian Advantage is structured a little bit differently than global ops in that there kind of are certain kind of risk / kind of return parameters, and we're much more cognizant in terms of correlations, exposures, kind of weightings, etc. And I'll hand it to Jim. I mean, Jim is the one that's generally more active in making sure that the fund is within those parameters. And that's very helpful for me because that allows me to express my views the way that I believe they should be expressed. And Jim is very good and tactical in terms of managing those exposures, managing those correlations. And obviously, it's kind of a reasonably easy extension to kind of what he does on the top-down macro fund. But we're able to use, with Jim's contribution, other vehicles beyond just kind of traditional equities to kind of manage some of those kind of exposures and correlations in Canadian Advantage that I wouldn't necessarily do in global opportunities. Global opportunities is mostly long short equities, North American, and stuff that I'll do beyond that from a vehicle standpoint would be reasonably low, but I will employ different strategies within that from a equity standpoint. But at the end of the day, it's still equities.
Great, thank you. And I think Colin will just move to the next slide. Sure. Yep. And I think this slide really highlights what we're trying to deliver across our entire Liquid Alt platform, and something that we'd like you to take away from today's presentation. And that is simply an alignment between us and your client expectations, and achieving that with responsible price point. And over time, we've been able to deliver a track record of results in both up and down markets. And when you build a track record like the ones that we have, you work really hard to defend them and continue to grow those track records. So I think if there aren't any other questions on the line today, what we'll do is we'll wrap things up. And so I'll just finish off by saying, if you want a copy of this deck, by all means, please reach out to your Arrow representative. They're all highlighted here for you on the screen. A replay will be provided, so please look out for that. I want to thank Chung and I want to thank Jim for their time today, and absolutely to everyone who's logged on. We greatly appreciate your time and the opportunity to do business with you. We look forward to continuing to do so in the future. So if, again, if you have any questions beyond our time here today, please don't hesitate to reach out to your Arrow sales rep. This concludes our presentation for today. Thank you very much, everyone. Have a great rest of the week.